Hi everyone. Today, we're diving into a specific financial term that sounds complex but is crucial for many businesses, especially those in real estate. We're going to talk about qualified non-recourse debt. Don't worry, we'll break it down into simple, easy-to-understand pieces. This concept is super important for how certain businesses, like partnerships, handle their taxes. It helps partners deduct losses they might otherwise not be able to. Let's get started. First, let's understand non-recourse debt. Imagine you buy a property. You get a loan for it. If that loan is non-recourse, it means the lender can only go after the property itself if you don't pay. They cannot touch your personal assets, like your house, car, or bank accounts, even if the property's value drops below the loan amount. It's a loan where only the collateral, the specific asset it's tied to, is at risk. This type of debt is very common in real estate investments. Now, let's add the qualified part. This is where tax law comes in, specifically for partnerships and S-corporations. Normally, when you're a partner in a business, you can only deduct losses up to your basis. Your basis is essentially your investment in the business. It's the money you put in, plus your share of profits, minus your share of losses and distributions. Without the qualified part, non-recourse debt usually wouldn't increase your basis. But qualified non-recourse debt is special. It allows partners or shareholders to include a share of this debt in their basis. This increases their basis, which then allows them to deduct more losses from the business for tax purposes. So, what makes it qualified? The debt must meet several specific conditions set by the IRS. First, the debt must be borrowed by the partnership or S-corp. Second, it must be secured by real property. This means the loan is directly tied to a specific piece of land or a building. Third, it must be from a commercial lender, like a bank. It cannot be from one of the partners themselves. Fourth, the terms of the loan must be commercially reasonable. This means it has to look like a normal loan you'd get from a bank, not some special deal between partners. Finally, the real property must be used in an activity of the partnership or S-corp. If all these conditions are met, then the non-recourse debt is qualified. Why is this so important? Because it directly impacts how much loss a partner can claim on their personal tax return. Without it, many partners might have a very low basis and wouldn't be able to deduct their share of business losses, even if the business is genuinely losing money. Qualified non-recourse debt essentially allows partners to at-risk more money for tax purposes, even though they aren't personally liable for the debt in a non-recourse situation. It's a specific rule designed to address the unique nature of real estate financing in partnership structures. It helps ensure that tax deductions accurately reflect the economic reality of the investment. Thank you so much for watching and learning about qualified non-recourse debt with me today. I hope this explanation was clear and helpful. If you found this video useful, please consider giving it a thumbs up. Your support helps this channel grow and allows us to create more content like this. Don't forget to subscribe for more insights into the world of finance and business. See you next time.